Hi, this is Jeng, and today I'm here with Satya Masina, and we're going to talk about a recent deal that he recently acquired and then refinanced. And so, Satya, maybe to jump in, tell us a little bit about Hazelwood Apartments.
Hi, James. Thanks for having me. Hazelwood is a 34-unit property located in Princeton, Texas. Princeton is about, east of McKinney, which is the fastest growing region, and Princeton by itself between 2010 and 18, there was a population growth of over 70%. So Hazelwood is, typical, I would say, Class C kind of property with a good mix of 1, 2, and 3 bedrooms. It had good bones to begin with, and we went in and improved the property and took advantage of the rent growth in the area and so on.
So we just sort of talk a little bit more about the acquisition. You know, a lot of people get hung up on finding the deal, and sort of how did this deal come to you, and how did you get it under contract? Because that seems to be a big barrier for people when they're first getting started.
Sure, James. So prior to this, we did buy, a few smaller properties. At that time, we just sold a 24 unit in Farmersville. We listed with one of the prominent, multifamily brokers in DFW. We've actually, listed few deals, bought about 4 or 5 deals with them. They're the ones who sourced this. This was not a listed property. It was an off-market. Kind of owner wanted to sell, not sell. As long as if the price is right, they were willing to sell. When we saw this, particular property, we liked the location, we liked the value add component, and we came. We looked at the financials, and of course, we had to go back and forth, before we, finalized the deal. But we were able to offer competitive pricing and so on. But the property itself came through a Marcus Militia broker.
So why do you so sort of it sounds like you sort of built a relationship with one listing broker,
Yes.
and they had saw that you've transacted, you've bought, you've sold
Yes.
similar deals, and so that allowed
Exactly.
you to sort of get a look at this deal first.
Exactly.
And a lot of people, they see a deal, and it's not, this deal wasn't fully stabilized. It wasn't 90% occupied. It was 85% occupied. So you had to go out and do more of a bridge loan on the initial acquisition. And so, how did you get comfortable? Number one, doing a bridge loan, but then confident in your ability to, really raise rents. Like, how did you know that once you got in there, you'd be able to raise the rents? Because the guy who's owned here, you put long term owners. I don't know how long he owned the deal, but that guy's been in the seat for a while, and he hasn't been able to increase occupancy. He hasn't been able to push rents. So how did you feel comfortable, and what was sort of the game plan going into the acquisition?
Absolutely. So, coming to, prior to this deal, we did have about 3, 4, experience with 3, 4 properties, going in, raising up the rents and things like that. What we have consistently found, James, is that owners who own properties for a long time, especially the smaller mom and pop owners, they have a very low basis, and they're not actively staying on top of their properties because I guess they're comfortable with what they're making, and they miss out the opportunity. For example, the Princeton was a growing area. There's a lot of population moving in, but there's a the product is not there, in the town. And whereas I was going out making calls, looking at apartments.com, whatnot, to get the latest trend on the rents, what I've seen consistently is that existing owners, they become complacent. They're not staying on top of what they can do, and then it's also their personal. What we have looked at is some they're happy with, I guess, with their financials. So it's like they're not putting in the efforts. That's
So,
pretty much it. It's
so
not a
to
rocket science other than that.
yeah, so they're it's not broken to them, right? So
Yes.
they're even at 85%, even at low market rents,
Yeah.
they were making money,
Yes.
and so
Exactly.
they just, hey, don't fix it if it's not broken.
That's right.
And so you came in, yeah. So here you're saying, all right, we're gonna come in, do interior upgrades, some water conservation, maybe update the exterior, and then maybe pull in some laundry income. So you bought the property in 2018, is that right?
Yes. In
Okay, so
October 2018.
so 2018. So fast forward to after you close in 2018, what did you do now with the property to really increase the value and cash flow on the property?
So day one, we had about 5 units vacant. So we quickly started off with them. Um, the units by them, the previous owner, they've done some upgrades, but none of the units were consistent. It didn't have all the components required to get the right rent, like to get the full potential from each unit. So we started with those 5 units. We upgraded them. What we thought was it's going to extract the maximum potential. We were able to quickly prove leasing them up. Almost like over $200 above the in-place rents. And then what we have done is we've taken advantage of several month-to-month leases. So we were able to stagger, and consistently, upgrade about 2 to 2.5 units, like, for the next 12 to 14 months. Um, and that was a continuous process. We were staying on top of it, and whatever research we have done earlier, it kind of proved that there was demand in the market, and we were able to, lease up consistently.
So we have a picture here on the bottom of an interior.
Hmm.
So talk about maybe what you did on the interiors, how much did you spend, and how long did it cost to sort of do these upgraded units?
Sure. So to begin with, some cabinets were oak, the older brown color. Some units had the older, the brown plank, the vinyl. Some units did have the plank, but it was not consistent. So there were carpets and things like that. And then, so what we've done is, kind of gray planks all in all units, backsplash, white cabinets, cabinet fronts, the hardware, black appliances, and so on. Upgraded light, fan fixtures. Good vanity in bathrooms. Good mirrors and things like that. Standard stuff that that people have been doing in an apartment upgrades of late. And
And how much
apart
did it
from,
cost approximately per unit?
I would say about 3,500 to 4,000,
Okay.
considering, there were, I mean, some units had, planks and things like that. So, yeah.
And it took what, I don't know, a couple weeks, or how long did it usually take to come in, do the upgrade, while the unit was getting turned over?
Yeah. So this is another issue. Actually, it's a good question. What I really like to focus is the turnaround time.
Hmm.
I've seen a unit sit there for 3 to 4 weeks just for the same turn to happen, and we've also got the same thing done in about little over a week.
Hmm. Yeah.
This is where, like, we use the third party make ready crews. We try to get competitive pricing, but also the key is to reduce the turnaround time.
So, so on this deal, we haven't talked about it, but you self-manage this deal,
Yes.
and so a lot of people have different ideas of what self-management means. Maybe explain how you're managing. So this property is maybe 30, 45 minutes away from your personal residence. How do
Mhm.
you manage this property in terms of payroll, in terms of tracking expenses, in terms of managing these upgrades? How do you do that?
Sure, James. So when I say self-manage, right? I mean, obviously, I'm acting the role of a regional manager of a property management company. But I'm the owner. I'm overseeing everything. But even from my first property, I've always had some are they perfect? Probably not, but I had a staff. So my goal is never to, touch the keys, lease them. I mean, show the units or, write leases and collect rents. My job is to, implement the big picture, progress the business plan, and so on. So coming to this particular property, I also have, I mean, at that time, I also had over, other portfolios. I was owning about 140 units, but they were all smaller, multiple 24, 32, so on. All within a, 5, 10, 15-mile radius. So I was paying a property manager, she has come from a bigger property management company. So I'm paying her well, but, so my payroll was, you could compare to, how you would underwrite for a 140 unit bigger property. My payroll is approximately the same. But obviously they had the trouble of going into multiple properties within a week. I
So
mean,
you're sharing, let's say this deal is 34 units.
mhm.
And, most people, if they only had this one property and they had to pay that property manager and a maintenance guy, it might be $100,000. But since you're sharing that property manager
Mhm.
across maybe, let's say, 2 or 3 properties, your
Yes,
total payroll might still be 1,000 to 1,200 a door, which might be
that's right.
$30,000 to $40,000 on this deal, which
That's right.
makes it run a lot more efficient because you're
Sure.
able to share that one person across multiple properties.
Absolutely. And I'm also, since I'm not paying that 4%, or 4 to 5% management fee to a property management company, I can afford to pay a little bit more to my managers,
Okay.
and I can afford to, spend, make some mistakes sometimes and then learn from it. But I had the luxury of that, not paying that 40% and utilizing that money to kind of, self-manage and gain some strong operational experience in turning around these properties.
So a lot of people who use third-party property management, they get like a monthly, it might be a 300-page PDF from their
Mhm.
management company
Mhm.
on the 15th of the month, and it's it has the rent roll, T12, general ledger, all that stuff.
Mhm.
Um, how do you, as sort of a self-manager, can you recreate that, or do you use any type of software that helps in that process so that it just seems like a mountain of information for someone to take a look at? And so how do you sort of manage that? Is there anything that you track, whether it's weekly or monthly, at this property and other properties?
Sure, absolutely, James. So, I always say this, we are buying smaller properties because at that time, we were limited by, individual money and things like that. But that doesn't mean that you cannot think big, like, like how you manage the bigger properties. From the very beginning, the one thing I've noticed is, exactly what you said, how you, I mean, when you look at bigger properties and, when you try to underwrite, the amount of information or professional information they provide in terms of rent roll, T12, other reports and so on. And I kind of compare that with, several mom and pop, smaller owners who provide financials on, Word doc and, things like that.
Right.
So from the very beginning, I mean, these days, you have all the tools required, and it doesn't cost much to implement the similar property management, very advanced property management software, like we use RESTman, which is the same software used by bigger property management companies, managing 20,000 units. But I was also able to implement the same software in cloud, for 30 units, 40 units, across my portfolio. So I'm generating the same quality of rent roll, T12s and so on. Obviously, in a bigger companies with property management company, you're not the one who's doing the accounting,
Right.
entering the invoices into the system and things like that. But that kind of data entry, can always, you can take advantage of a high school kid, because, or even you can train your property manager to, put in the invoices into the system and things like that. So, yes, I use a lot of, tools, so for example, I also subscribe to Blue Moon, which is a standard, lease forms, standard Texas Apartment Association forms. So it doesn't matter, whether you're big or small, you can use these tools at a very minimal cost and produce similar, professional reports.
Because it's just software, right?
Yes,
And it's you can use it as needed,
yes,
and turn it on when you have a property, turn it off when you don't have a property.
yes,
And this goes into when we went into when you go into Fannie and Freddie. So Satya came to me sort of at the beginning of this year and said, "Hey, look, let's look at this deal. We've been able to raise the rents. The income's up, the value's up." Because of the impact that we've had on the revenue side of the P&L. Now we have to take it into Fannie and Freddie. And the first thing that they ask for is show me your P&L, show me your rent roll, all those things that you've created in RESTman. And it just comes off so much better than if it's just an Excel sheet with, one or two line items for rent and one or two line items for expenses. So you're able to provide all these reports. And so talk about, why you decided to go with the refinance versus just selling this deal outright, and sort of how that process went for you.
Sure, James. So this is the, I've done similar, where bought properties with bank loan, and I've always actually sold them. And this is the first cash out refinance, I'm doing. The reason is that I feel that while I've done significant value addition, I'm confident with the location of the property, and I feel that it still has potential, and maybe provide me a stable cash flow for a long time. I am focusing on bigger properties right now, so I thought it's also getting hard to source deals, like a good value add deal. So why sell it at this point while we still have some value addition to extract from this deal. That's the reason we went for a refinance at this point. And of course, as we are growing, we also didn't want a recourse loan sitting on our books. And of course, if we are able to take advantage of cash out situation, we want to make that money work and things like that.
Yeah, to go from sort of recourse to non-recourse to sort of reset the term of the loan. So most bridge loans are 5 years. So instead of having a maturity in the next couple years, you extend the maturity and sort of take away that maturity risk.
Yes.
You go to 30-year amortization, you drop the interest rate, and you get some cash back into your pocket for potential opportunities going forward. That checks all the boxes on a refi of why you want to do it. And with the recourse bank loan, you didn't have a big prepay, right? So it's not like you had to pay off a big yield maintenance or something like that on the prepay. And you already know this property, right? So you've owned the property for 2 years, you know exactly what you got. And, you can sort of incrementally approve it here on the rents, rubs, and then the laundry income. So I wanted to jump in and hit you with some quick fire questions here on this last slide.
Mhm.
Actually, before we do the questions,
Mhm.
just give a snapshot of some of the other properties that you've bought and sold in the last 5 years or so.
Sure, James. I'm an IT guy. Like I started off with multifamily in 2015. With my first property was 37 units in McKinney. Um, Typical value add deal. Much. I mean, C class. Much bigger value addition than Hazelwood we just covered. The following year, I did buy another 24 unit in Farmersville. Third year, I sold the Elm Street, the 37 units, and I was able to do a 1031 exchange into a portfolio in Garland, Colonial and Town Central together. There were 55 units. And as part of the same exchange, I also purchased another 30 unit in Courtyard. So it was a big jump, just by selling 37 units and just bringing in some additional money to the table. I was able to jump in from 37 to almost 87 units, within a span of 18 to about 20 months, I would say. And the following year, I sold the 24 units in Farmersville, and again, that's when I purchased this Hazelwood. In the same year, I also bought another property in Wiley. It was 24 units. So, that volume of almost like 140 units gave me the confidence to quit my IT job in mid 2019. In 19, I've done another transaction, sold that 55 units in Garland, acquired another 18 units with a partner in Red Oak. And 2019 was also the first year where we have done a 100-unit syndication, which is north of McKinney, and another great property. And come to 2020, we closed on another syndication in Fort Worth called Richmond. And then, of course, Hazelwood, we've refinanced it. And, when we sold this Colonial and Town Central in last year, we've not done 1031. This is the first time I've not done a 1031. And we were able to mitigate a lot of capital gains through bonus depreciation mechanism. So we are sitting on that money, of course, the money from the Hazelwood, we are actively looking to purchase and, buy bigger properties and so on.
No, that's perfect. I mean, you've definitely stair-stepped your way up into bigger and bigger properties. And, I just want to hit you with a couple questions. So I think we've covered self-management. Maybe talk about the biggest obstacle on your multifamily journey so far. I know it's early, but maybe what's one obstacle that you've had to overcome sort of in this journey?
So I guess the biggest obstacle is getting that first deal done, right? First deal, and I would say within the first deal, the first loan as well, because you can even without buying anything, you can always contact a broker. You can tour the property, you can do a mock underwriting and things like that.
Sure.
But what I mean, at least at that point when I first bought my property, I was not part of any networking groups or mentoring groups, so I was learning things on my own. But beyond just touring properties and kind of looking at the financials, I've not prepared myself for the loan. And if you actually, in fact, my first loan was with you, and if you recall, I think the first one was PFS.
Yep.
Oh wow!
Personal financial statement.
I've not even done a personal financial statement.
Right.
So that transaction process is like, where the first bank loan. They've asked us to write a business plan for the deal. So it was a lot more difficult. But obviously, you've learned a few things. And then, apart from that, I guess my other, biggest obstacle is, what I thought was that raising money from other people for syndication. While I was building my experience, I was not sure how raising money would play out, but that was actually much easier than I thought, and it's more of the obstacle was in my mind, but not in the the actual work and things like that.
Yeah, just two comments. Yeah, the loan process can sort of be like an autopsy.
Yeah,
It's in detail, a lot more detail than most people want it to be, but that's just how it is.
yeah,
And then, yeah, the raising money piece, I think definitely as you build sort of a track record or partner with people who have a track record, it helps people get comfortable with you.
sure.
Um, so, what is one thing you're going to do the same, and one thing you're going to do different potentially on the next deal?
Um, if I may, James, I mean, instead of the next deal, I mean, the way I want to look at it is that I'm going to follow the same conservative, mechanism, and this is like any business. I mean, it's not like you can, people think that you can invest and you can go play golf and money is going to come in. But I think this is definitely like, I mean, especially when you're starting off and with smaller properties, it's much more active. So the what I'm going to do the same is definitely my discipline, our conservative underwriting, and then staying on top of things like during the operation. What I'm going to do different is that obviously we've for last 5 years, like we've gained solid operational experience, and we were too focused on buying on our own, and buying smaller deals. But I think the next 5 years is what we want to achieve is the scale. So we want to achieve the scale for next 5 years. So the next, and also the what I'm going to look at differently is that so far we've also been looking at mainly at big value addition, where our payout is mainly during the sale and refinance. But going forward, I'm primarily going to focus on the cash flow, the yield component of the property, more stabilized. I mean, of course, with some wherever possible value addition, but we're more going to focus on the yield and cash flow.
Yeah, I mean, especially as you hold these deals longer, right? Most people can do a heavy value add if they're going to get paid out after 18 months, but
Yes.
it's going to be harder if you have to hold a deal for 5 years or 10 years. If there's no cash flow for 10 years or 5 years,
Exactly.
then the investors are going to get restless. And so you're counting on that sort of pot at the end of the rainbow. I guess the last question here, I think, on this slide is, what is the one thing that differentiates you from all the other GPs out there?
Sure. I mean, there are many good GPs out there. I'm learning every day from them. But I guess the difference. My core competence is definitely it's not just putting a deal together. I think I bring in a lot of operational experience. So what happens between the purchase and sale or refinance, right? That part, we know in and out. Be it stable operation or value addition, like cost effective management and things like that. And I've put in my personal money and gained that experience. So I guess as a GP, what differentiates me is that yes, I'm going forward, I'm going to utilize third party management companies, but since I bring that operational experience, I know what to ask, with the property, management companies and things like that. So it's definitely putting a transaction together, and that operational experience is also gives you a good disciplined underwriting perspective as well. So
Yeah,
that's
yeah,
what
it's
is
it's it's
primarily.
absolutely, yeah, it's absolutely when you know what's going on at your property that's a similar size in a similar submarket.
Mhm.
You're not just going off of pro forma and just hoping that's what it's going to be. you know exactly
Exactly.
what it's going to be when you get in there. And so
Yeah.
that's a huge differentiator. And you know, to me, it increases every deal you do, every deal you do in that submarket, it increases that competency. And
Yeah.
so I really appreciate you coming on today. And you know, I think you told me we've done 10 loans now. So appreciate all the business and anything that you want to leave people with, and what's maybe the best way for people to reach out to you if they have questions about this deal, about some of the other deals you've done, or potentially future opportunities.
Yeah. First of all, thanks for having me, James. It's always pleasure to work with you. I kind of, I think this is a long-term relationship for both of us. The one other advice is that definitely is anybody starting out is to build a good team, right? I mean, it's like that's just like you cannot put value to that. It's just like helps you in the long run, like a good team on the loan side, on the brokerage side and things like that. So people can contact the best way is to definitely through email, satya.p.masina@gmail.com, and they can also contact me through phone. I'm open for talking to people.
Well, I appreciate it, Satya, and appreciate you coming on. And thanks a lot. And we'll be talking soon.
All right, thanks, James.
See ya.
Appreciate it.
Bye.